In chapter two, we're going to be talking about the general financial reporting theory. In theory, what things should any company that has to report information to another party include in that information, and what way should it be presented? This isn't the specific rules for any one scenario, it's the big overarching concept behind why the rules are designed that way. So, to start things off, let's talk about the conceptual framework. The conceptual framework is a idea created by the Financial Accounting Standards Board that is the theory behind why things are set up the way that they are. And when in doubt, the way that is the best to present information. It's not any specific rule. So this doesn't override an accounting standard. It's just more in concept of what is the goal that we are trying to accomplish by reporting our financials in this way to other parties. So the conceptual framework is broken down into 8 parts, all of which you'll be covering this semester in AC 201. Starting off with the objective, which I'm talking about right now. The reporting entity, how do you describe the scope of the company that you're reporting for? What are the characteristics of good information, useful financial reporting so people can make decisions off of your stuff? What are the different elements that you should report to people? What should be included on your financial statements? How do you recognize that things have happened within your company? How do you recognize that you've earned revenues or paid off liabilities or whatever? And in the case that something was recognized that shouldn't be recognized, how do you de-recognize it? Some items will have variation in what could potentially happen in the future. That's measurement. What is the best way to measure things? You have come across that topic, I'm sure, before, but way back in financial accounting, when you had the ability to say, when you make a sale with credit terms, are we going to get the discount or not? That's a level of measuring there. What's the best way to recognize the situation? Presentation, what should your financial statements look like? And then lastly, and this is the one that's kind of very new to AC 201 for most MVCC students, the notes to the financial statements. Sometimes there's more detail that's not included in the financial statements. For example, if you have a very big notes payable showing on your balance sheet, I think users or information are going to want to know, when's that due? When does that note have to be paid? What are the terms of that note? That's information that you would disclose, but not in the body of the actual balance sheet. It goes into the notes at the bottom of the balance sheet. So this semester, you're going to be having some notes to your financial statements that provide a little extra information for certain line items that people will probably want that information for. So, the overall objective, if you had to put what's the purpose of financial reporting into one term, it is providing this word right here, useful information. Our objective is to put very organized information in the hands of people that are trying to make a decision about our company. People that could potentially invest in here, lenders we could potentially borrow from, hopefully people we don't owe too much money to, but creditors as well. And it can go on and on. There's more than just this, though. That's the primary parties. Potential customers would maybe want some information that you have on there. If you want to work with another business, have them being a vendor too. They're probably going to make sure that you're going to continue to be in business to buy from them. They're going to know your financials as well. But all of them want something that's going to be useful in helping them make their decision. And information to these companies isn't on demand. Like if I want to, if I'm thinking about investing in Apple, I can't just call up Apple and be like, hey, what's your income so far for the month? They're like, they only report it periodically in the thing. So there's not on-demand information for people. It's over a period of time and summarized, but it's still good enough and accurate enough and fast enough to help people make decisions about what happens right now. They call this the qualitative characteristics of financial information. And in short, and FASB loves writing way too many words to get a point across. The two things that you should have is the information included should have relevance. It should be relevant to the decision that someone's making about your company. And it should be, if you will, accurate. It should be faithfully represented, that you have all the events that actually happened during the period on your books, and they went into the calculations of your numbers that ended up on the financial statements that you have at the end. So those are the two things that are just foundational, fundamental to accurate reporting is determining what is the most relevant information that you want people to know at the time. What are they going to need to make decisions? and accurately and faithfully representing it on your financial statements. Further points down here, just breaking the things down, relevance. If it's relevant, it's going to help somebody make a prediction about your company. What are you going to do in the future? Or you can go backwards looking. It's going to have confirmatory value. That relevant information is going to have to be there if someone wants to make a decision about was their assumption about your company correct? And then materiality information is relevant if omitting it could cause someone to make a, as they say, material difference in their decision. I'm not super concerned if somebody forgot to put a $5 transaction on the books. That's kind of immaterial to me for a multi-million dollar company. But if it's a $5 billion loan that never shows up on the books, it's very material to my decision making. So maybe a small expense when somebody took money out of petty cash doesn't end up on the books. It's not very material. Humongous loan, incredibly material. As far as faithfully represented go, it has to be complete. It has to be for the entire period. You can't pick and choose the points that you want to have, and when you represent it, you have to have everything that happened within the accounting period on the books and in the financials for that same period that it happened in. The information you have to have has to be neutral, not favoring one party above the other, and as best as humanly possible, free from error. So have somebody go through and check your numbers. That's what's foundational. That's what's fundamental, relevant, accurate information. But for the users, there's other things that they're going to want to have to help them make a decision. And a big one of that is comparability. If you are looking through a whole bunch of different companies and you want to invest in one of those companies, you want everybody's financials to look relatively similar. Like it's a nightmare to have to go through and have 35 different formats. So comparability is setting up your financials and disclosing information using the same rules as everybody else to help you make a fair comparison between your different alternatives needs to be verifiable. So you need to have it set up in a way where somebody else reasonably informed in how accounting works can go through, look at your numbers, look at your events that you had during the period, and come to a reasonably the same amount of information that you have, the same income, the same total level of assets, etc. And for me, the big one here is timeliness. And in the 21st century, it's a very good thing to have that we can work faster than we used to in the past. If I wanted to make a decision about investing in, I'll stick with Apple in this case, and it's September, and the last information that I have from them is from December of the prior year, that's not really timely to what is happening right now. So companies typically report every 3 months, so they have some reasonably recent information that is timely for decision makers to use. The big constraint of the information that gets provided to users of that information is the cost. Accountants don't come cheap, and I'm sure a lot of you got into this field or are studying to go into this field because you know accountants make good money. There's a whole bunch of information. Like we could go crazy with our books, putting every little detail possible up on there, but we have to pay an accountant to do so. And that's an expense to our business, and that's going to lower our profitability. And if you put yourself in the role of someone who's invested in the company, you want the company to be as profitable as possible. And FASB knows this. So they want to have all of the information that's on there that's faithfully represented and it's relatively complete in this case. But at the same time, if you take it too far, if you're the government agency overriding things and you require just way, way too much information, what are you doing to investors? You're causing the company to incur a ton of expense for a little bit of information that's not going to materially affect their decision. It's not going to be very beneficial to them. And then you're lowering the amount of profitability that can be handed out to those users of your information in the form of dividends or lower prices if you're selling to some of them or whatever. So, accounting information should be as thorough as humanly possible. But there is a point where trying to get too much information there is actually detrimental to the company. And the framework is looking for what information is easily attainable and affordable that companies can have where we're not going to negatively impact the profitability of this company for the people that are using that information.